Investing may seem daunting when you're just beginning, but it is a crucial component of saving for financial objectives and creating wealth. As you embark on your investing journey, it is important to recognize that you will encounter various market conditions, so don't become too preoccupied with the perfect time to start or watching the market daily. However, before making any investments, it is essential for novice investors to determine their risk tolerance. Different investments come with varying levels of risk, and it is critical to avoid being caught off guard after making an investment. Reflect on how long you can go without the funds you intend to invest and whether you're comfortable with not accessing them for several years or more. Number 5. High-yield savings accounts. One of the easiest ways to increase the return on your money beyond the rates offered by a traditional checking account is through a high-yield savings account. Typically, these accounts are opened with online banks and offer higher interest rates on average than standard savings accounts, while still allowing customers to withdraw their funds as needed. High-yield savings accounts can be an excellent option for holding funds that you're saving for a purchase in the near future or keeping as an emergency fund. Number 4. Mutual funds. Mutual funds offer investors a chance to invest in a diversified portfolio of stocks, bonds, or other assets that may not be easily accessible to them otherwise. Among the most sought-after mutual funds are those that track popular indexes, such as the S&P 500, which consists of roughly 500 of the largest American companies. Index funds are typically accompanied by low fees or no fees at all, benefiting the investors by allowing them to keep more of the fund's returns and providing a viable long-term strategy for building wealth. Number 3. ETFs. Exchange-traded funds, ETFs, are comparable to mutual funds as they both hold a collection of securities, but ETFs are traded throughout the day like stocks. Unlike mutual funds, which usually require a minimum investment of a few $1,000s, ETFs do not have the same investment requirements. Investors can purchase ETFs for the price of one share, plus any applicable fees or commissions, and some brokers even allow fractional share investing, enabling investors to get started with even less capital. Number 2. Individual stocks. Purchasing individual company stocks is the most uncertain investment option discussed here, but it can also yield significant rewards. However, before engaging in trades, it is essential to evaluate whether investing in a particular stock is the right decision for you. Reflect on whether you plan to invest for the long term, usually spanning at least 5 years, and whether you comprehend the intricacies of the company you are investing in. Stocks are subject to constant price fluctuations throughout the trading day, and this often leads investors to adopt a short-term trading mindset. It is important to remember that buying a stock equates to owning a portion of an actual business, and as the company grows, so does the value of your investment. If you are unsure of your knowledge or aptitude for individual stock investing, it may be safer to opt for a diversified approach provided by mutual funds or ETFs. Number 1. Only invest what you can afford to lose. There is a common misconception that investing in the stock market requires a significant amount of money. However, smaller investors who regularly contribute small sums of money can actually perform better than those who invest a large lump sum. It's important to keep in mind that you should only invest what you can afford to lose, especially during a market downturn, which can result in significant losses. To minimize risk, many financial advisors recommend investing for a minimum of 5 years, which provides sufficient time to recover from any market fluctuations that may lead to losses. Overall, before investing your money, it's important to assess your risk tolerance and financial objectives. For beginners, it is recommended to explore investment opportunities that provide convenient access to funds, such as high-yield savings accounts, to address unforeseen circumstances. On the other hand, stocks are typically more appropriate for a strategic long-term investment approach.